This is the video demonstration on liabilities, and in this video I'm going to work the solution to example number 9. This example involves the Intex company, and it says that they had the following transactions related to various liabilities in the month of October. And we see several transactions that occurred throughout the month, and under the requirements we are simply required to prepare the necessary journal entries for each one of these transactions. So to do this, I have a journal entry page set up in Excel. You could do that, or you could do this on paper, but I will have to do a separate journal entry for each one of these transactions. So the very first transaction occurs on October the 1st. We sold merchandise to a customer for $1,200, but the sale occurred in a state with a 5% sales tax. So this entry will be dated October the 1st. We have completed a sale, and it's a cash sale. So I'm going to debit cash because I'm receiving the money. So I can always do that because that will raise the value of cash. Now I also have revenue in the form of sales, but I'm going to skip a space in between, and you'll see why in a second. But I'm going to skip a space before I put the credit to sales. Now the actual amount of the sale, if we go back and look at October 1st, $1,200. So I'm going to credit sales for $1,200. But up here on cash, when I debit cash, I'm going to use a different amount. The reason is this is in a state with a 5% sales tax. So when the customer gives me the money, they're going to give me more than $1,200. In fact, they're going to give me the $1,200 plus the sales tax. So if the sales tax is 5%, that means I'm going to get 105% of $1,200. So 1,200 times 1.05, that gives me 1,260. So when I actually collect the money from the customer, it will be 1,260. So now you see why I left that empty space there. Because see how it doesn't balance. I've got 1,260 on the debit side, only 1,200 on the credit side. So I need another credit of $60 to make this journal entry balance. What is that going to go to? Well, that's going to be a liability. And it's a liability called sales taxes payable. Because think about it, that $60 that I have is not my money to keep. I owe that money to the state, and eventually I will pay that to the state. So that's actually a liability. So that takes care of the very first transaction for October the 1st. Now October the 3rd, we borrowed $10,000 by signing a 30-day note bearing 7% interest. So from time to time we have situations like that where we borrow money. So we'll date this October the 3rd. How much are we borrowing? $10,000. So this will be a $10,000 journal entry. Since we are borrowing money, we will be receiving the money, so we can debit cash. And on the credit side, that's going to be a liability, but it's a specific type of liability, note payable. Why is it a note payable? Because it's a written agreement and there's interest involved. Now notice that I did not calculate any interest, and that's because I don't calculate the interest until I pay the money back. So initially I just record it at the initial amount, which is the $10,000. So that completes that entry. Then on October the 5th, we had another sale. This time we sold merchandise to a customer, $320, and this is in a state with a 5% sales tax. So this one will be treated very much the same as the very first entry that we did. So this is October 5th. We will receive cash. I'll skip a space. We'll have a certain amount of sales. The sales value in this case was $320. I'm actually going to receive more than that. I'm going to receive 320 times 1.05, 105% of 320, which is 336. There's a difference there of $16, and we know exactly how to handle that. That's sales taxes payable. So that takes care of that transaction. Then we get down to October the 7th. It says we paid the balance due on a $20,000 60-day note bearing 8% interest. So evidently up here on the 3rd, that's not the only time we borrowed money. We must have borrowed money in another time, 60 days ago, 2 months ago, and now we got to pay the money back on that. So this is on October the 7th. Now if I'm going to pay off a note, I'm going to remove the note. So the way to remove a liability is to debit, because liabilities are debit negative. So I'll debit note payable. And then I'll skip a space and I'll credit cash to show that I'm spending the money. Now the actual note payable said was a $20,000 note. But down here on cash, I don't necessarily know how much I'm going to put there, because I'm going to also have to put something right here. And that's going to be a certain amount of interest expense. So if I can figure out how much interest, then I'll be able to figure out the total amount that I have to pay. Now remember, we talked about interest in our video lecture on liabilities. And you know that there's a simple interest formula, and it's principal times rate times time. So in this case, we've got $20,000. That's the principal. The rate, it said, was 8%, so that's 0.08. And time, it's a 60-day note. Well, we know that, of course, banker's interest is based on 360 days. So it's going to be 60 out of 360. So then I'm going to multiply all three of these elements together. P times R times T, principal times rate times time. I get 266.7. If I round to the dollar, it's about 267. So that means I will pay $20,267 total on that note payable. So remember, on notes payable, you only calculate the interest when you pay the money back, and it's based on simple interest, principal times rate times time. The next transaction is on the 15th. We remitted the sales taxes collected to the state for the first half of the month. So this is on the 15th. Now from time to time, the money that we've collected on sales taxes does have to be sent to the state. So that means I can actually debit sales taxes payable and credit cash, because I'm eliminating the liability and settling it with cash. Now at this point, how much state tax have I collected? Well, for the first half of the month, I had a sale on the 1st where I collected $60. Then I had a sale on the 15th where I collected $16. So far for the first half of the month, I've collected $76 in state sales tax. So that is how much I will remit to the state. Then on October 25th, yet another sale. Again, in the state with a 5% sales tax. This time it's a different sales amount, $750. We know exactly how to handle this because we've had a couple of these so far. So I'm going to receive cash. I'm going to have sales taxes payable as a credit and sales as a credit. So the sale in this case is $750, but I'm going to receive $750 times 1.05, or 105% of $750, which is $788. Well, that's a difference of $38. So I'll debit cash $788, credit sales tax payable $38, credit sales $750. And then the final transaction is on October the 31st. It says that we're going to recognize the warranty cost for the month. And it says warranty costs are for all products sold, and we're estimating it to be 2% of sales. Well, remember, we talked about warranties in our video lecture on liabilities, and I said then that the company is required to at least estimate a certain amount of warranty cost. So this is going to be on the 31st. The proper titles to use, we saw an example of this in the other video. It's an expense. It is a warranty expense, so that must be debited. And it is a liability, but it's an estimated liability. It's an estimated warranty liability. We just have to figure out the amount. Now, it's based on their previous experience, so they're saying it's based upon 2% of sales. Well, before I can do that, I got to know how much total sales they've had. So they had several sales that occurred throughout the month. They had a $1,200 sale on the 1st. So we have that one, $1,200. That was borrowing money. Here was another sale, $320. That was paying a note. That was paying back the sales taxes. And here's the third sale, $750. So we basically had 3 sales. We had one for $1,200, one for $320, one for $750. So $1,200 plus $320 plus $750. Total sales $2,270. So I want $2,270 times 0.02. 2% of that is about rounded about $45. So I'll book an estimated warranty liability for $45. So that completes the transaction on October 31st, and that completes example 8 on liabilities.